our YIS online global club meeting. Today we're going to be going over Unit 2, Lesson 1, Fluctuation and Market Cap. And Rushi is our YIS Student Advisory Board instructor today. And so he's going to go through the lesson with you, and I'm going to give it off to you, Rushi. If you're ready.
Yeah. You want me to share my screen?
Yeah.
Cool. Can I see that all right?
Yes.
All right, cool. So, we're on Unit 2, the value of a stock, and Lesson 1, the role of Mr. Market. So let's start with overview. So after this lesson, you will develop an understanding of why stock market prices fluctuate from day to day, week to week, and year to year. You'll learn about Mr. Market and practice locating stock information using online resources such as finance.yahoo.com. And objectives at the end of this lesson, you should explain who Mr. Market is and the role he plays in stock market fluctuations, and locate stock information online or with other resources. So this is a quick video. All right, I'll start over.
Young investors, in this next unit, we're going to explore how to determine what the value of a stock is, one of the most critical questions for any investor. I still remember a day in college when my finance professor brought in a copy of the Wall Street Journal, and he turned to the stock quote section and said, pick any company at random and look at the high and the low of the stock price from the past year. So I randomly picked General Motors, and over the past 52 weeks, their stock price had a high of $40 a share and a low of $15 a share. That meant in just 12 months, the market had estimated that the value of GM as a company was as high as $64 billion and as low as $24 billion, a difference of over $40 billion in value. And then we looked at other companies, and the high volatility was similar. So was the real value of GM changing that much? Change that much year to year. A Chevy Silverado last year is still a Chevy Silverado this year. It's not like they're figuring out how to fly to the moon or replace gasoline with water. It was basically the same business last year as it was this year. So what in the world was going on? When I checked with my classmates, the same thing was happening for the companies that they chose as well. Why was it happening to every single company in the stock market? Was last year an exceptional year of price swings? Nope. Is there something that the market knows that we don't know? Nope. So what's the explanation? I remember my professor leaned in and he smiled and he said 6 simple words. It just goes nuts. Legendary investment teacher Benjamin Graham tells the story of Mr. Market, and you'll learn about it in this unit. It basically paints the market as a pretty moody guy, up one day, down the next. So does this mean that we shouldn't invest in the stock market because of these wild swings up and down? To the contrary. The fact that we are offered deals from time to time should make us very excited. Our goal is to, 1, identify what the company is worth, and 2nd, wait for Mr. Market to have a bad day and then buy at a discount. Benjamin Graham calls this giving ourselves a margin of safety, which you'll remember is one of the golden rules from our previous unit. Okay, you're thinking, this is all well and good, wait for the market to go crazy, and then buy below the fair value. However, there's one problem. How can we be sure that we even are close to knowing what the value of a company is? How do we know that our forecasts are even with computer programs waiting to scoop up bargains as soon as they become available? Surprisingly, not as many as you think. During this unit, we'll go over why the market goes up and down and begin to explore various ways to calculate the true value of a company. Enjoy, and remember, sometimes the market just goes nuts, but that's where the opportunities are found.
So donuts. Normally we would give you them out, but obviously it's online. So here's a virtual donut. How much would you pay for one donut? Right. Usually it's $1, maybe $2, maybe $3 if you go to a really nice place in New York. These donuts here are all the same. Would you pay more or less for one of these than you would pay for the others? What if the world has a sugar shortage and it's the last known box of donuts? Would you pay even more? The answer would probably be yes. If it's the last box of donuts, obviously there's going to be more demand for that one box of donuts, so the price goes up. What if you just ate a box of donuts and you aren't hungry? Well, if you just ate a box of donuts, you probably are pretty full, so you don't have like a appetite for another box of donuts, so you probably won't pay for another one. So the donuts represent a company, especially in the stock market. So what could you do to maximize the value of the box of donuts, or in this case, a company? Here's a video.
Well, I've got no idea where the market's going to go. Just have nothing to do with it. The market knows nothing about my feelings. That's one of the first things you have to learn with a stock. You buy 100 shares of General Motors. Now, all of a sudden, you have this feeling about General Motors. I mean, if it goes down, you may be mad at it. You may say, well, if it just go up to what I paid for it, my life will be wonderful again. Or if it goes up, you may say how smart you were and how you and General Motors have this love affair and everything. If you've got all these feelings, stock doesn't know you own it. Stock just sits there. It doesn't care what you paid. It doesn't care that you owned it or anything. So any feeling I have about the market is not reciprocated. I mean, it is the ultimate. It is very cold shoulder we're talking about here. And anybody that is going to be a net saver, practically everybody in this room is more likely to be a net buyer of stocks over the next 10 years than they are a net seller. So every one of you should prefer lower prices. I mean, if you're going to be a net eater or cattle producer, and if you're going to be a buyer of Coca-Cola and you don't own Coke stock, you hope the price of Coke goes down. I mean, you're looking for it to be on sale this weekend at your supermarket. You want it to be down on the weekends, not up on the weekends when you're going to attend the supermarket. Your stock exchange is a big supermarket of companies, and you're going to be buying stocks. What do you want to have happen? You want those stocks to go down, way down. And, you will make better buys then. And later on, 20 years from now, 30 years from now, when you're in a period when you're dis-saving or when your heirs dis-save for you, after you're gone, I mean, then you may care about higher prices. But I find people, that was one of the, there's a chapter 8 in Ben Graham's Intelligent Investor about the attitude towards stock market fluctuations. And that and the chapter 20 on the margin of safety are the two most important essays ever written on investing as far as I'm concerned. Because when I read chapter 8, when I was 19, I figured, I just figured out what I just said, but it's obvious. I didn't figure it out myself, though. It was explained to me, and I've probably gone another. We want things to go down, but I have no idea what the stock market's going to do. I never do. I never will. It's not something that I think about at all. When it goes down, I look harder at what I might buy that day. Because I know there's more likely to be some merchandise there that I can use my money effectively in.
Okay, Warren, what thing?
So some things to discuss. So what do you do when the market goes down? And what does Buffett mean when he talks about things being on sale? And do you agree with this approach? Does anyone have any comments? No? So I can start off. So what do you do when the market goes down? As you said, if the market goes down, you wait. You wait and research and you see, why is it going down? Is it going down because the company misreported their financial statements, which can be bad for the company? Or is it going down just for like a normal fluctuation? And maybe that's a time to pounce and buy the stock. So what does Buffett mean when he talks about things being on sale? He kind of is talking about like how stocks are undervalued. So say Apple goes down like some amount of percent. You know that Apple's still a good company. You know that Apple's still reputable. So it's kind of on sale if it goes down. So that's when you should like look and do research and maybe buy there. And I do agree with this approach because stocks are volatile. Some days they're really low, some days they're really high. So when it's really low, you want to take a good look at it and see, hey, is this really on sale? Is this really undervalued stock? And then take a risk with that. So learning activity intro. So if everyone can go to Yahoo Finance, it's shown on the screen, and search for GM. I'll give everyone like a second to open it up. And then you click on key statistics underneath company on the left-hand side. And you look at the high and low prices of GM stock during the past 52 weeks and the number of shares outstanding. These are some good statistics that you can use when determining if a stock is undervalued or overvalued. So now let's go to handout 2.1, which is Mr. Market's Kit. Gotta have that open. So does anyone want to do this skit with me? If any volunteers? Doesn't seem like there. All right, so I'll just read them out loud. So Mrs. Investor and Mr. Market each own half the shares of their company, Kites Incorporated. So on Monday morning, Mrs. Investor says, good morning, Mr. Market. How was your weekend? Mr. Market says, it was horrible. Do you see the wind reports in Greece? We need to sell this business. Mrs. Investor says, I enjoy being a partner, but I don't see what our business has to do with Greece. Our customers are all in the United States. We shouldn't be hasty. To that, Mr. Market responds, fine, you stay here if you want. I'll sell you half my shares in Kites Incorporated for half their value. Mrs. Investor responds, okay. So Mr. Market stops at the office. The next week, Mr. Market says, good morning, Mrs. Investor. Did you have a great weekend as I did? I feel like we can do anything. The spring weather is great for our kite business. And Mrs. Investor responds, good to see you again, Mr. Market, but I thought you were throwing in the towel when it came to our kite business. You sold me all your shares for half the price. Mr. Market says, I've changed my mind. Things are on the upswing. I can feel it. I want back in. Mrs. Investor responds, what are you offering? Mr. Market responds, I'll pay you double what those shares are worth. Mrs. Investor concludes, sounds great. Glad to have you back. The following week, Mrs. Investor says, good morning. How are things going for you today? And Mr. Market says, I guess things are going okay. I really thought my shares would go up more by now. Plus my coffee was cold this morning. Mrs. Investor starts, well, we have steady profit growth, no debt, and a solid business plan. I think patience is key here. Mr. Market says, I don't know. I think I'm looking for something more exciting. Can I sell my stocks back to you for the original value? Mrs. Investor says, that doesn't sound a great deal for me. I'm not going to purchase them at this time. Mr. Market says, well, I'll just find someone who will. So some discussion questions. So how would you describe Mr. Market? The correct answer would probably be like mood swings, impatient, prone to making hasty decisions. This is kind of like your immature investor. When they see things going down, they just quickly act out of fear and want to sell a stock without taking the time and research and sitting back and maybe having some more patience, which is what Mrs. Investor is. She's patient. She realizes in the long term this company has potential, and she sits. She researches and makes sure that she's prepared for the future. So the value of the business isn't changing much from the day to day. So in this business, for example, from one week to another week, the business isn't drastically changing. Like Warren Buffett said, like the instructor said before, the stock's just having a bad day or a bad week, but it's going to come back up at some point. Well, the only thing that does change is Mr. Market's moves. So we can't let Mr. Market keep us from investing. Just because one person said it's going to go down or just because other people think it's going down, that doesn't mean you should act on that. Instead, you should try to take advantage of what he's saying. So if everyone else is saying the stock's going to go down, the stock's going to be really bad, you have to say, hey, everyone else is going down. Maybe I should capitalize on that and research more and then look to make a profit. And this is called margin of safety. We can wait for Mr. Market to have a bad day and get a stock at what we want at a cheap price. And the question is, how do you know the value of a company? How do you know that a guess about how much a company will be correct? And the thing is that you don't know. It's volatile and sometimes things happen that's out of your control. What you can do is stay prepared. You can do your research. You can go on Yahoo Finance. You can check out a bunch of statistics and make sure that probability-wise, you have a better chance of being right than incorrect. And think of something you bought that you have a killer deal on, and how'd you get that deal? And how is this deal similar to stock market? So maybe something, one thing is Travis Scott. He has really good merchandise. So when you go to his concert, his shirts cost like $30, $40. But after that, they tend to cost like they resell for like $100, $200, $300. But you don't know that when you buy the shirt. They just look like normal Gildan t-shirts. But you take the risk on it. You see that it just really undervalued. You buy a bunch of t-shirts and you can potentially sell that for more. So that's how kind of the stock market works. So then we'll go back to this. So how much would you give me for a $10 bill? Probably $10. Would you give me $10 $1 bills? 10 $1 bills for the $10 bill? Or would you give me a $20 bill for the $10? The most successful investors are able to find and purchase stocks that are worth more than what they really cost. Do you think Mr. Market is a good or bad for investors? So to answer that previous question, Mr. Market is probably good for the knowledgeable investor. If he's really acting really rational and he's not thinking well, that's good for the smart investor because the smart investor is research. Smart investor knows what he's talking about, and then he can actually act when the market's crashing and he knows that this company's going to stay solid, it's going to keep on doing well. He's going to hold on to his stock or he's going to buy more, and that's good for the smart investors. So activity for next class: economic mode, market capitalization, initial public offering. So we can play Kahoot. I don't know if we have enough people for that. Is anyone interested in playing? So I think to wrap up, so here are some more resources if you want to get more information. And that's it for this lesson.
Perfect. Thank you so much, Rushi. Did you have an idea of the week by any chance to share with us?
Yes. You mean idea of the week?
Yes.
Like this. Yeah. So one thing I was looking at is like how the election is going to affect the stock market. Because obviously that's a very important thing that's coming up in the next few weeks, especially in the United States. So outside being too political, there's two parties, obviously, the Republican and Democratic. So when you look at the reports, it's kind of interesting how the stock market responds to each side, because obviously the Republican platform advocates for more tax cuts. So that's more attractive to a lot of executives and a lot of like the big businesses. So the market tends to spout upwards when the Republican wins. But for the first time, we're seeing it when projection is showing for the Democratic side, there's also projections going up, which is really interesting to me. And if you guys have any thoughts on that, because I think, I don't know, because I think the market wants to be stable and a lot of companies want stability, and they're seeing the Democratic side as the solution for that. And maybe that's the reason why the projections are indicating that, but we don't know exactly how it's going to turn out based on the election. So if anyone wants to add to that, you can unmute yourself. Think no.
it looks like we have some shy members today.
Yeah.
Thank you so much, Rishi. That was awesome. I'm going to take it over from here and start the discussion on our $1 challenge. So let me go ahead and share my screen. So I just want to go over the $1 challenge. I know we have some new students who might not be familiar with the program, but basically the $1 challenge is challenging you to save $1 a day into a personal brokerage account. And you can do that several ways. If you can open a brokerage account, that would be our #1 choice. Most brokerage accounts for students are custodial accounts. That means a parent opens it for you, and if you're under the age of 18 years old. So a custodial account is the way to go. If you're unable to do so, a checking account, a savings account, any kind of banking account at any financial institution would also work. So basically, we challenge you to save $1 a day in a personal account. You can do that any way you like. You can actually do $1 a day. You can do $30 a month, $90 a quarter, $365 for the year. Whatever that looks like for you is perfectly fine with us. All we ask you to do is to send us your bank statement in June to see how much you've saved. We select 100 students who are eligible for our free money match scholarship. In order to be eligible for the scholarship, we require you to write an essay. The essay this year is on, can money buy you happiness? Why or why not? So 100 students will be selected from their essay to win our scholarships. For fall, it's up to $365. We do a $1 a day challenge in the spring, and that's up to $182.50. So just wanted to go over a couple of things with you. This is the impact of our $1 a day. So basically, if you're at the age of around 15 years old, if you start saving $1 a day, which is equivalent of a can of soda, this is what it looks like for you. So by the age of 70, you would have $1.5 million of your own. If you did the $1 a day match, you can have up to 3.1 million. And then this second generation here is if you have your children invest and what that looks like for them. So I also have another graph that shows you a little bit of how important it is to start young and to start investing young. This blue line here says Jack invests $200 per month starting at age 25, and he contributes a total of $96,000. So you can see that his $96,000 at the age of 65 turns into a little over $500,000. Now Jill, who's green, invests $200 per month starting at the age of 35, and she contributes a total of $72,000. And you can see that at 65, she has roughly $250,000. So a huge difference between Jill and Jack on the ages that they start investing. And Joey down here is in orange. He invests $200 per month starting at the age of 45. And he contributes a total of $48,000. And you can see at 65, he has just over $100,000 to show for it. So this just shows you how much starting early really affects investing. And so that compound interest has so much more time to compound and be able to get you where you need to be. So I thought that was a very interesting graphic to show you guys. So I'm going to go, let's stop. I'm going to go to see if you guys have any questions for me about the $1 a day challenge and how that works. I know a couple of you have received the $1 a day challenge scholarships from last year. Does anyone want to talk about their experience? Ryan, I'm picking on you. Did you want to tell us about your $1 a day experience?
Sure, I'll speak about it a little bit. I mean, it's not super difficult, which I think is something that makes it really appealing. I mean, it's 1 to 2 pages, which is pretty, I mean, a reasonable mark. So And plus what you get from that, I mean, I think last year it took me no more than a couple hours, and definitely what you earn from that is worth it. So I highly encourage anybody who's interested to do it.
Yeah, it's one of the easiest ways that you guys can earn money, honestly. We say a page because I actually have to read all of them. So honestly, a page is great if you can write a page on the topic. And I really want to see your honest opinion. I mean, I know what you probably think I want to hear when I ask you, can money buy you happiness? But I also enjoy when kids are just really honest, and I want to read about, yes, it can, because money can buy you donuts, and donuts make me happy. So I really want to just see what you guys think, and I encourage you to just take some time, write your $1 a day challenge essay. Again, the topic is, can money buy you happiness? Why or why not? Super easy to do. We have the application on our website, YIS.org. It's under programs, $1 a day challenge. It basically just asks you a couple of questions and you submit your essay. Essays are due November 30th. So make sure you get those in. Like I said, it's the easiest $365 you'll make this year. So does anyone have any questions? All right, well, if you guys think of anything, or if you have anything after the fact, you can always email me at ctobin@yis.org. I'm always here to answer your guys' questions, but if you don't have anything, that's it for today. Make sure you tune in next week. Next week, we will have a discussion with our YIS founder, James Fletcher, who's going to be giving us some stock market advice during COVID. So that should be a great discussion. So I will see you guys next week.
See you guys.
Bye, guys.
Bye.